Is a brand new federal law about to change your finances if you are a senior? The answer is yes, and if you do not understand exactly how it works, you could miss out on real money that is legally yours. This is not a rumor. This is not something floating around social media. This is an actual federal law already signed and already scheduled to affect millions of seniors starting this tax season. So today we are going to break down 3 things. Number 1, what this new law actually does and who qualifies. Number 2, why so many seniors are confused about it and getting it wrong. And number 3, the specific steps you need to take right now so you do not leave money on the table. Stay with me because the details matter more than the headlines. My name is Professor Liam. I am an adjunct professor of finance at Johns Hopkins University, and I am the author of the upcoming book, The Social Security Playbook, 7 Big Decisions and 75 Essential Answers to Get You Every Dollar You Deserve. This book releases on August the 19th, and it exists because I have spent over 15 years explaining Social Security and Medicare to everyday Americans who are tired of being told the rules without being told how those rules apply to their own decisions. If you are new to this channel, welcome. Do me a favor and drop your city and state in the comments so I know where you are watching from. Let's start with what this law actually is, because there is a lot of noise out there and most of it is wrong. Earlier this year, a piece of federal legislation known as the One Big Beautiful Bill was signed into law, and buried inside it is a provision that directly affects seniors age 65 and older. This provision creates a brand new enhanced deduction of $6,000 for individuals and $12,000 for married couples if both spouses qualify. This is not the regular extra standard deduction that seniors have always gotten. This is a completely separate, additional deduction stacked on top of what already existed. Effective for tax years 2025 through 2028, this means it applies to the return you are filing this year for income earned last year, and it will continue for a few more years unless Congress extends it or lets it expire. Now here is where the confusion starts, and this is exactly why I wanted to make this video. A lot of seniors are hearing new deduction and assuming that Social Security income itself is now tax-free. That is not accurate. This law does not eliminate taxes on Social Security benefits. What it does is give you an extra deduction that reduces your taxable income, which can reduce or in some cases eliminate the tax you owe on your benefits, but only if your income falls within the right range. That distinction matters because if you go into tax season assuming your benefits are simply untaxed now, you could underpay and get hit with a surprise bill. So who actually qualifies? You must be 65 or older to claim this. The deduction begins phasing out once your modified adjusted gross income crosses $75,000 for single filers, or $150,000 for joint filers. If your income is below those thresholds, you get the full $6,000 per qualifying person. If you are above them, the benefit shrinks and eventually phases out completely at higher income levels. This means the seniors who benefit the most are middle-income retirees, not the wealthiest and not the lowest income seniors who may already owe little or nothing in federal tax to begin with. And here is a detail almost nobody is talking about. If you are married, you generally need to file a joint return to claim this new deduction, and each spouse claiming it must have a valid Social Security number. Filing separately can disqualify you from this benefit entirely. I have already seen confusion online where people assume they can claim this filing separately the way they normally would with other deductions. Please do not make that mistake. Talk to a tax professional before you file if you are unsure which filing status protects this deduction for you. Now let's stack the numbers so you can see exactly what this looks like in practice, because this is where most people get lost. For this tax year, the basic standard deduction sits at $16,100 for single filers and $32,200 for married couples filing jointly. On top of that, there is the regular age-based extra standard deduction that has existed for years, $2,050 for an unmarried senior, and $1,650 per qualifying spouse on a joint return. Now add the new enhanced senior deduction, up to $6,000 per qualifying individual. Stack all 3 together and a single senior under the income threshold could be looking at a total deduction well above $24,000 before a single dollar of Social Security tax liability is even calculated. That is the real math, and it is the reason I want you checking this carefully instead of letting a rush tax preparer skim past it. Now let's talk about why this law exists in the first place, because context matters. For years, seniors and advocacy groups have pushed back on the fact that a portion of Social Security benefits becomes taxable once your income crosses certain thresholds. Thresholds that, unlike almost everything else in the tax code, have never been adjusted for inflation since the 1980s. That means more and more retirees have been pulled into paying taxes on their benefits every single year, even though those thresholds were originally designed to only affect the wealthiest retirees decades ago. And here is why. The excitement is real. If you qualify, this is legitimate extra money staying in your pocket, money that used to go straight to the IRS. But the caution is just as real. This deduction is temporary. It is scheduled to end after 2028 unless Congress acts to extend it, which means seniors who build long-term retirement income plans around this benefit could see their tax picture shift again in just a few years. Retirement planning built on a temporary tax break is planning built on sand, and I want you thinking 5 years ahead, not just this April. There is also a fairness conversation happening underneath all of this that you should know about, because the deduction phases out at income levels well above what most retirees actually earn. Critics point out that lower-income seniors, the ones who already pay little or no federal tax on their Social Security, see almost no benefit from this law at all. The people who benefit most are retirees sitting right in that middle income range, the ones with enough income to owe tax on their benefits but not so much income that the deduction phases out. If you are barely scraping by on Social Security alone, this law may do very little for you directly, and that is an uncomfortable truth that does not get enough attention in the headlines. So here is what I want you to actually do with this information. First, do not file your taxes this year without checking whether you and your spouse qualify for this new deduction, because tax preparers and even some tax software have been slow to catch up on how this stacks with the existing senior deduction. Second, confirm your filing status protects this benefit, especially if you are married, because filing separately can cost you thousands of dollars you were entitled to. Third, do not assume your Social Security income is now automatically tax-free, because that misunderstanding alone could cause you to underpay and face penalties later. Fourth, treat this as a temporary window, not a permanent fixture, when you are building your longer-term retirement income strategy. And fifth, if your income sits close to either the $75,000 or $150,000 threshold, sit down and calculate your modified adjusted gross income precisely before you file, because a small difference in reported income right at that line can change whether you receive the full $6,000, a partial amount, or nothing at all. I also want to address something I am already seeing in the comments on other channels, people asking whether this new deduction means they should change how they withdraw from a 401k or an IRA this year to stay under the threshold. That is a legitimate strategy worth discussing with a tax professional, because the timing of retirement account withdrawals can directly affect your modified adjusted gross income, which in turn determines how much of this $6,000 deduction you actually get to keep. This is exactly the kind of decision where a general rule is not enough. You need to look at your specific numbers before you decide anything. I know a lot of you are going to have questions about how this interacts with your specific income, your pension, your part-time work, or your spouse's benefits, and that is exactly the kind of one-on-one discussion I have inside my community called The Circle. It is where I break down breaking news like this in real time, answer direct questions, and help people figure out exactly how new rules apply to their own numbers instead of just the general rules everyone already knows. Almost 150 people have already joined, and if you join today you get access to over $250 worth of guides I have built specifically to help you maximize your retirement income, along with over $2,500 in additional perks and discounts. I will drop the link to The Circle in the description and pin it in the comments. And do not forget, my brand new book, The Social Security Playbook, releases on August the 19th. It is built around the 7 biggest decisions every retiree has to make and 75 specific answers to help you get every single dollar you are entitled to, not just the rules but how those rules actually apply to your life. I will put a number in the description if you want to join the waitlist and be the first to know the moment it is available. Let me know in the comments if you were already aware of this new senior deduction before today, or if this is the first time you are hearing the real details instead of the confusion floating around online. And if this video helped clear things up for you, hit the like button, hit subscribe, and most importantly hit the notification bell so you are the first to know the moment Congress makes its next move on Social Security, Medicare, or any other law that affects your retirement.